Don't rock the boat. Megatech, California wildfires, the return of no-deal Brexit, and an explosive book about President Trump all work to set the markets on edge. This is Bloomberg Wall Street Week. I'm David Westin. This week, Speaker of the House Nancy Pelosi.
We need a stimulus in terms of job creation.
Contributors Larry Summers of Harvard, Afsaneh Beschloss of RockCreek Group, and Stephanie Flanders of Bloomberg.
Many people in the financial markets are expecting them to have to do more to stimulate the Eurozone economy before the end of the year.
Ross Gerber of Gerber Kawasaki, Dan Chung of Fred Alger Management, and Rick Rieder of BlackRock. There was nothing quiet about this first week of September. Tech stocks continued to take the markets down and then brought them part of the way back. Historic wildfires destroyed enormous parts of Northern California and Oregon. British Prime Minister Boris Johnson said he was prepared just to walk away from his agreement with the EU over Northern Ireland. And if all that weren't enough, President Trump admitted on tape that he knew all along how bad the coronavirus was, but didn't want to tell the rest of us because he was afraid of panic.
I wanted to always play it down. I still like playing it down.
Yes, sir.
Because I don't want to create a panic.
All in all, it was a wild week. But in a sea of uncertainty and volatility, the central banks offered us all a steady lodestar, with the Fed's increasingly easy monetary policy seeming to put a floor under U.S. equities, and the ECB stayed the course, supporting the European economy with continued low interest rates and robust bond buying.
Overall, the balance of risks to the euro area growth outlook is seen to remain on the downside.
So the question as we end the week is whether this was a tempest in a teapot or the start of something more ominous. And to get us started on some answers to those questions, we welcome now our virtual roundtable with Wall Street Week contributor Afsaneh Beschloss, founder and CEO of RockCreek Group, and a special friend of this program, Rick Rieder, BlackRock Global CIO of Fixed Income and head of its global allocation team. So welcome to both of you. Great to have you. So I'll start with you, Afsaneh. What is it? Was this just some short-term turbulence? Was there a major rotation going out of growth and into cyclicals? Or actually, could it be something worse?
David, I think this could be the beginning of maybe some correction in the long term. I think we saw a lot come back at the end of the week. But we also think that coming into the rest of the year before the election, what we're going to see is much more volatility like we saw over the last 10 days.
Fair enough, Afsaneh, but Rick, I wonder whether the Federal Reserve Board hasn't, to some extent, put a floor under that volatility because of their incredibly accommodative monetary policy. Are they sort of protecting us all?
So I think that's right to a large extent. I mean, I think people underestimate when the Fed drops the discount rate to zero, drops the interest rate to zero, you create a dynamic that is extraordinary for, I mean, equities are long durated assets. They are the risk asset that gets the biggest multiple when you bring the interest rate down. I think what the Fed's doing, and rightly so, is providing accommodative policy to an economy that needs it. But they're also, I don't think you can underestimate the liquidity they're putting in the system that is extraordinary. I've never seen in my career this sort of liquidity that's flooded through the system. The amount of cash that's on the sidelines is incredible. And again, some of this is when the Fed takes treasuries, agency mortgages, investment grade credit, and makes them such rich assets, that you force the equity market higher. And I think the markets, while volatile this week, there were some technical conditions that were creating that. I do think the markets are generally in a pretty good spot.
So, Rick, it's nice to have free money as long as the prices don't go up. There was some talk this week about possible inflation coming back. Is there some risk of that at this point, particularly if we get a vaccine and this virus goes away?
So, David, I have a different view. I think we've been on your show for many years and talked about, I think people worry about inflation for years and talk about, historic trends. When you grow the monetary base, it leads to inflation. When wages accelerate, it leads to inflation. We're in a very different world, and we've talked about it for years, about how technology and pricing power becomes different, A, in a globalized world, but B, in a technology-driven world where you're seeing efficiencies being played out in an extraordinary way. I think the traditional metrics don't create that much inflation. We do think inflation is moving higher. but we think it's very different than you've seen historically. I mean, today we got a pretty good inflation report that came through. But some of that was you had a boost from used car prices, you had a boost from apparel, you had a boost from food away from home, and those are things you'd expect to accelerate after you go through a crisis like this. So I do think inflation is moving higher, but I'm not that worried that you're going to see similar inflationary conditions that you saw in a manufacturing-driven, commodity-driven set of economies 20, 30 years ago.
Afsaneh, given where we are on the discount rate and the interest rate, which is approaching zero essentially, you can't put a lot of money into bonds and make a lot of money. Where are the opportunities to make money? Tech had been, but has that basically had its run at this point?
Well, that is what I think this uncertainty that I was talking about is going to impact most, because regardless of what the election results are, and I think a lot of people think elections could lead to, one scenario or another, I actually think that there is going to be more uncertainty about technology getting some form of regulation moving forward, regardless of the result of the election, which might start creating some sort of correction in tech stocks, looking again, not in the next week or two, but looking over the next several months. And I think the other thing that is very interesting, in fact, one of the writers for Bloomberg was talking about this very early this morning. If you look at the graphs of how much debt is getting created, it is absolutely enormous. It could, by the end of this period that Rick was talking about, end up being equivalent to World War II levels of debt, and on a relative basis, and to the economy. And so if that happens, you see US and Europe, in fact, with huge debt burdens. But if you look at the China numbers on debt, you don't see the same level of debt in China relative to their GDP as we're going to see in the US and Europe by the time we're done with this. So we can't assume that there'll be no impact on any of this. Talking about opportunities, though, I think, again, not to talk about negative things, as we have had huge problems with the fires in California. But what they're demonstrating is that climate change is very much with us. And David, in fact, basket of stocks that we look at RockCreek, which are looking at the renewable energy stocks versus traditional ones, we look at a basket. And in fact, you saw over the last few months that the renewable stocks are about up 35%, while the traditional stocks are down about the same amount. So looking at opportunities, I think that will be definitely one area, looking at how climate and cleaner energy could create jobs and could create investment opportunities as we move forward.
Rick, as somebody who puts money to work, whether it's on the fixed income side or in your asset allocation on the other, to what extent do you take into account the possible outcomes of the election? Because you could have a very different result, for example, with clean energy, depending on whether it's a President Biden or a second term of President Trump.
I mean, it is. I mean, we're moving into the season now. It's hard to invest when you think about the election. We invest in May and June and July. But as you get into September, October, now we're starting to think the reality is setting in about you could have a significant change in terms of where we go, not just obviously at the presidential level, but what fabric of the Senate looks like, et cetera. So you start to think about, where could you see some volatility? As you said, I think, energy, some of the renewables, but some of the healthcare names. Also, the markets actually, in some places, tend to over-discount the change that you could potentially see. So we find like areas such as defense, some of the defense companies that are stable cash flow, where you won't see significant change in defense spending. We think the markets actually overdo it because they tend to anticipate, gosh, this is the traditional modus operandi, and then, gosh, do I want to be in defense? And I think some of the areas we're looking at managed care and parts of the healthcare market that I think the markets have overly discounted. So it's actually, you have to have learned in markets over the years that when markets start to get conservative and be careful about the anticipated change, that's the time that you actually need to start taking the risk, because that's where the real return comes from. So you just got to make sure that it's priced right and take advantage of it when it is.
So I'm starting to wrap this up. It strikes me we've had this whole discussion. Nobody's mentioned stimulus. We've been talking for months about a fiscal stimulus, fourth round. Is it just not that important anymore?
I think it's even more important because the stimulus we've had so far has obviously helped to some extent, but there's so much more unemployment to go, and so many companies that will still lay off people, so much dislocation in the markets, and so much dislocation with small businesses, as we read every day. So there is a huge need for stimulus. Plus, there is a need for better roads, better airports, better infrastructure in this country. So both in terms of both the need for growth and productivity, but the growth in terms of the needs of this country, both need us to do a lot more. And I think I was reading Rick's piece on looking at the need for investment and R&D, which I think, Rick, you wrote this a couple of months ago, but it is a timeless piece, I thought, and very relevant to our days today.
In my experience, Rick's almost always timeless. No question. Just to wrap up, final word, Rick, do you agree we've got to have that stimulus?
Oh my God, I thought it was perfectly well phrased. I mean, you can get deluded into believing there was a shock, the amount of the stimulus that came into the system that certainly improved income levels. Now you're seeing some rapid improvement in employment, but we should not be deluded into believing that the economy has enough momentum on its own. It needs stimulus, it needs capital investment, it needs infrastructure, state and local funding, healthcare funding. There is more that has to be done. And listen, I actually think the points around debt are definitely right. I actually think the system, if you put more people to work, you can absorb a bit more. So it has to happen.
Fascinating. Okay, many thanks now to Rick Rieder of BlackRock and also to Afsaneh Beschloss of RockCreek Group. Coming up, the ECB says the European economy doesn't need more help, at least not yet. And contributor Stephanie Flanders says the only thing surprising was how positive its message was.
We were wondering whether she would sound even more downbeat. And in fact, as you suggest, the overall tone of her press conference was, if anything, upbeat.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. The European Central Bank had a tricky task this week, keeping its support for the economy where it was, even though there are some signs of trouble ahead, leading ECB President Lagarde to plot a steady course.
In the current environment of elevated uncertainty, the Governing Council will carefully assess incoming information, including developments in the exchange rate, with regard to its implications for the medium-term inflation outlook.
Bloomberg Senior Executive Editor for Economics and Wall Street Week contributor Stephanie Flanders says that, if anything, Madame Lagarde seemed a bit more optimistic than expected, given where some data are pointing.
The formal language out of this meeting was exactly the same as at the last meetings, pointing to the fact that risks were on the downside. But coming into it, I think there were a number of people in the markets considering the data in the last few weeks in Europe had not been so great, that you've seen the recovery leveling off and even starting to go down, the momentum sort of weakening in quite a few European countries. We were wondering whether she would sound even more downbeat. And in fact, as you suggest, the overall tone of her press conference was, if anything, upbeat. And we actually have heard, Bloomberg had heard soon after the meeting that some members of the council had wanted to be even more upbeat in their language and had been overruled.
So are they seeing something in the numbers? Because the numbers they had came up marginally. I mean, they're not cheery economic numbers, but nevertheless, whether it's GDP growth or whether it's inflation, they come up some amounts since the last estimate.
Yeah, I mean, there was no big change in the forecast, but you're quite right. The growth forecast was just a tiny bit better, but they're still expecting a big hole to be missing in the European economy at the end of the year due to the COVID recession. The inflation numbers looking a little bit higher, but actually that probably doesn't take into account the fact that the euro has been soaring in the markets in the last few weeks. So certainly this is not a time when you would think that they would be changing their signalling around around risks. And if anything, as you know, many people in the financial markets are expecting them to have to do more to stimulate the Eurozone economy before the end of the year.
Stephanie, you mentioned the euro soaring. It really has been on an uptick, without a doubt. And that poses some challenges for the European Central Bank, because the higher the euro goes, the harder it is to get the inflation up, which is their target there. Madame Lagarde did address that, so they talked about it a fair amount, although she didn't seem to be overly concerned.
Yeah, and this, if anything, is the first time we've seen a shift in the Lagarde ECB relative to the European Central Bank under her predecessor, Mario Draghi, where the exchange rate, although, of course, they don't formally say they're targeting the exchange rate seemed to loom really large in their strategy for stimulating the economy. They always wanted to keep it down to help exporters, to help the economy. She was sounding, and we get the impression that the Council overall was not so concerned about the level of the euro or the fact that it's likely maybe to go up further, and that is a shift, and it's going to make it harder, as you say, to hit that inflation target, which at the moment they have no sign of hitting. It looks like in 2 years' time the core inflation rate will still be only 1.1%, so really half of the target they're trying to reach.
Now, they've indicated, as I understand it, that their extraordinary bond borrowing program will go through the middle of next year, but some people thought she might extend that. When do they have to really address that question of when they go even further with that program?
Yeah, there's an interesting debate on the Council about whether the amount that they've previously talked about for the special programme, the 1.35 trillion euros, was a ceiling or just a sort of overall amount that they're going to spend, and then they might think about spending more. They can keep up the bond purchases, as you say, through the middle of next year. There's no particular moment where they're going to have to announce a bigger envelope. But I think a lot of people in the financial markets, if you continue to see this trajectory of the economy, the recovery kind of bottoming out, or flattening out, not continuing, if you like, that last bit of the V, I think there will be quite a lot of question mark about whether they should increase the bond purchases at the end of the year, or at least announce that it's going to increase and extend longer than the middle of 21.
Stephanie, as you know well, in the United States, we really focus particularly on the jobs numbers every month and trying to figure out where the economy is. Give us a sense of the employment situation over in Europe, because it's done relatively well, as I understand it. But I also heard that some of these furlough programs may be expiring at some point.
You know, every government is facing the same challenge, and it's a version of the challenge that the lawmakers are facing in the US over the stimulus package, but kind of in reverse. The US has had a lot more people join the unemployment rolls, and then they have a debate about whether or not to keep those increased benefits going or not, or try and reintroduce them. In Europe, you have a lot of people who are not unemployed yet. They've managed to suppress, if you like, the rise in the unemployment rate they might have seen, because they have these furlough programs or versions of it where the government is basically paying employers to keep people on their books. There's an enormous program that was supposed to run out at the end of October in the UK, similar programs in Europe. Different countries are taking different decisions on this. Germany has said it's going to extend its program. Spain is saying it's going to end its program in September, but there will be a lot of difficult debates in different countries about that in the next few weeks, because at the moment, the unemployment rate much lower than in the US, because they have managed to keep those people on the books, but still effectively paid by the government, supported by the government.
That was Stephanie Flanders, Bloomberg Senior Executive Editor for Economics. Coming up, Tesla stock went up and up until it went down and down. Ross Gerber of Gerber Kawasaki thinks he knows why. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. If tech had a rough week, Tesla had a horrible one, with its worst one-day loss ever after it missed out on being included in the S&P 500. And then things got even worse when GM teamed up with its rival Nikola, taking a $2 billion stake in the company. Welcome now, Ross Gerber. He's president and CEO of Gerber Kawasaki, which owns a slew of Tesla stock. So you're a Tesla bull. Did it shake your confidence at all as you saw that come down 26% from the peak this week?
Well, no. I mean, in fact, I was more worried that it would keep going up, and it's like scary how much it's gone up. So to see a pullback of, 25-30% after a 500% run up, that's pretty normal.
So this is clearly the growthiest of growth stocks, if I can say that. It's really betting on the come, as it were. It's going to keep growing up. What's the proposition that says that it can keep going this way? How many cars is it going to have to make? Because right now, if you look at the number of cars it makes compared to its valuation, it's not that great.
Well, yeah, unfortunately, we're investing for the future, and not the past, because you're absolutely right. But I think what we're looking at is the fact that the entire infrastructure for the automotive industry is changing from gas to electric, and Tesla's leading the way. And Tesla is so far ahead of its competitors that it's going to take years for anybody to even develop a vehicle they can scale to compete. But what it is that consumers want electric vehicles and consumers want Teslas, and they're sold out every day of the Teslas they have. And so when you extrapolate out opening up a gigafactory in Berlin and also in Austin, as well as the China factory now coming on fully online, their ability is to actually double production in the next 2 years and then double it again in 2 more. So there are no car companies in the world that are even growing, let alone doubling production. And Tesla's a technology company. They're developing full self-driving, and also it's a solar and energy company. And the battery component of their business has enormous value as well. So Tesla isn't a car company. I think that's the mistake a lot of people make in valuing it.
Is it a technology company? How much of the intellectual property does it own as opposed to license?
Well, they own all their technology. In fact, they build it all in-house. And when you walk into the Tesla factory, actually, the first thing you see isn't the factory. What you see is tons of people working on computers. So they're a software company first and foremost, and they built a connected car. And so, like, when you use the Tesla technology, you really understand that building a car is a very simple thing. We mastered that, 50 years ago. It's not about building cars. It's about building self-driving technology, building an incredibly safe car, and building an electric vehicle. Because right now I'm in California, and literally the whole state is covered in smoke, and we just cannot live this way. And electric vehicles is one of the ways we can help solve climate. So it has to be addressed.
Ross, you put to a really important point. How much of the future of Tesla, the future growth of Tesla, is based on actually what the government does? I mean, we have right now Joe Biden run for president saying he's going to have a very different energy policy from President Trump. China has been out in front often and saying we got to have electric vehicles. How much is this really driven by government regulation?
Well, I think that's a big part of it, absolutely. And in fact, Tesla was started because the government wanted to invest in clean energy and lent them money to get started. And now, because of this enormous climate challenge and crisis we have, countries all over the world, except for the Trump administration, is full-fledged in trying to deal with that. And cars is the way. So China's decided to go all in on EV technology now and is developing some of the most advanced EV cars that we're seeing to compete with Tesla. And Tesla is also one of the top, if not the top selling EV in China. The United States policy will change dramatically under Biden, and it will be a huge benefit for Tesla and all of our green energy investments under Biden. But what Trump has shown is how much we need to change our policies so that we deal with climate, because we have no more time.
How big can it get?
Well, I've owned Apple my whole life, and if you would have told me 20 years ago Apple would be worth $2 trillion and the products and services, I would have said you're crazy. Yeah. So I don't know what Tesla will be worth, but if you look at dominating energy and storage, if you look at dominating EVs and self-driving technology, I mean, Tesla's $1 trillion company at some point. So, I think for a long-term investor, I hope Tesla pulls back more. It would be a great opportunity for the long-term investor. But I think on the short term, Tesla fully values this reality.
Ross, thank you so much. Ross Gerber of Gerber Kawasaki. Coming up, whatever happened to that 4th round of fiscal stimulus? Couldn't we use it just about now? We ask Speaker of the House Nancy Pelosi.
The chairman of the Fed and other Fed leaders around the country have said very clearly that we need a stimulus.
This is Wall Street Week on Bloomberg. Now it's the Senate's turn to propose another round of fiscal stimulus. After months of impasse on what would be in a 4th round of stimulus, the Senate voted on a slimmed-down bill, which Democrats say isn't nearly enough.
Senator McConnell says he's prepared a so-called skinny COVID bill, but he put it before us on a take it or leave it. No amendments, no debate. Well, this proposal isn't skinny, it's anemic.
The so-called skinny bill includes $258 billion for another round of checks for smaller employers, a $300 enhancement to weekly unemployment benefits, and a $10 billion grant to the U.S. Postal Service.
I think it shows where you're going to get 51 Republican votes. You're going to lose many of the more conservative Republicans if you get a top line that approaches even $1 trillion.
Majority Leader McConnell's bill is far from the $3 trillion package passed by the House in May, called the HEROES Act. That bill included $10 billion in emergency grants to small businesses and an extension of $600 unemployment payments each week through January.
A bad package would not be helpful. A smart, good package, well-targeted, would be helpful. Do we absolutely need it? No, I'm not going to precondition anything here.
Any further stimulus would add to a federal deficit already forecast at more than $3 trillion for this year. But that might not be a cause for immediate alarm.
Debt to GDP ratio isn't exploding. It isn't rising very rapidly at all. It's basically flat. And what that says to me is that we're in a relatively stable situation.
However we pay for it, the longer we wait for more fiscal stimulus, the less urgent it seems to be. But Speaker of the House Nancy Pelosi says it's needed more than ever.
We have tens of millions of people who are unemployed in our country, and whatever the analysis is of some, for them at their kitchen table, we need a stimulus. We need a stimulus in terms of job creation. We need money to invest in ending. This is just the mystery to me, why this administration has refused to invest in crushing the virus. Because only in doing that are we able to open the economy and open our schools safely. We need funding for keeping people from being evicted. We need food security funding and the rest. And all of this is stimulus. Food stamps are stimulus. Unemployment insurance benefits are stimulus to the economy. So while they are stabilizers, they're also stimulus.
So if that's the case, why aren't people across the way in the Senate, and particularly across the aisle, getting that message? Because they don't seem to be very inclined to come to the table and get something done.
Well, I don't know why they don't, because the chairman of the Fed and other Fed leaders around the country have said very clearly that we need a stimulus, that we need a boost. They've even referenced that state and local governments' fiscal soundness is important to the soundness of our economy.
Is there a deal, even though you might not want to take the deal, is there any deal you could take it off from the Republicans? I mean, you and the minority leader, Chuck Schumer, said today it's an emaciated bill. Is there a bill at all even for an emaciated bill? Because as you said, some people say not $1.
Well, what Senator McConnell put forth is fraudulent. It is, as Leader Schumer said, emaciated. It's not. They call it a skinny bill, and he calls it an emaciated bill, and I join him in that. It's only a check the box so that some of his endangered Republican senators can go home and say, well, see, I tried. But it isn't trying. It's not even an attempt to do the right thing. And Mitch McConnell knows that, because he has to satisfy those Republicans in his caucus who don't want to spend one more dollar, whether it's feeding the food insecure children in our country, saving their families from eviction, stopping the dismantling of the Postal Service so that people can vote without risking their health, again, first and foremost, crushing the virus and putting money into the pockets of the American people. What they have is so meager that it insults the intelligence of the American people, does not solve the problem, and it is not. Again, we know that we have to compromise. We know we have to negotiate in order to reach an agreement. We all want an agreement. Make no mistake about that. But get serious, get real, Mitch McConnell.
Well, let's talk about what...
He paused. He pushed the pause. Remember, May 15th, when we passed our bill, he pushed the pause button. It wasn't until the last few weeks that he's now even coming up with a suggestion. In that time, nearly 5 million more people have become infected since he pushed the pause button, and nearly over 100,000 people have died.
So talk about what it means to get serious. And I guess part of my question is, get serious with whom? Is it Senator McConnell that you're negotiating with? Is it Secretary of the Treasury Mnuchin? Is it Mark Meadows up at the White House? Who's on the other side of the negotiating table from you to get to a deal?
Well, certainly not Mark Meadows. But in terms of the negotiation, the Republicans have to negotiate among themselves. Mitch McConnell has this pathetic bill, which is half of what the Secretary Mnuchin has proposed. So they aren't even in agreement. They are in disarray. We have said we would come down. First, we came down $1 trillion. Then we came down and further and said we would meet them halfway. And some of that is because we can put off the timing of some of ours. We're not being Sophie's choice by saying we're feeding some children and not others. It's about timing, and we can have that negotiation. But to ignore those needs, how could they ignore the virus and the spread of it and the cost to our economy, our education system, and the rest?
That was Speaker of the House of Representatives, Nancy Pelosi. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm David Westin. Every week, we turn to our special contributor, Larry Summers of Harvard, to give us the highs and the lows and sometimes just the plain odd of the week. Let's call it Summers Says and get through as much of this as we can in a rather packed week, starting with our first question, Larry, which is, what was the biggest surprise for you this week?
That the President of the United States decided to give 18 hours of on-the-record interview to Bob Woodward with audio tapes that Woodward could make public. It was a prescription for showing his soul to the world in a context where he couldn't possibly have ended up looking good. In fact, he ended up almost worse than one could have imagined. But the decision to do that was inexplicable to me.
Well, and particularly because it's not like Woodward has never done this to anybody before. I mean, if you knew anything about Woodward's past, he's done this to person after person after person.
I mean, it says two interesting things. It says something about the degree of hubris the president has, and it says something about either the lack of strength, quality or lack of strength of his advisors. Because if anyone in any of the administrations I had served in had had any idea like that for the President of the United States, there would have been a clamor from everyone who worked in the White House that it was crazy and dangerous.
Yep.
So it was a mystery to me, but it's neither the first nor the last mystery about how this president conducts himself in office.
That also assumes that the president actually listens to any of his advisors. I'm not sure there's proof of that.
That's the point. Yeah, exactly. That's the point.
Okay. How about on the radar? Whether it's next week, next month, next year, what's on your radar that should be on ours that maybe isn't?
I think we need to pay attention to fluctuations in the dollar. For a long time, currency fluctuations have not been a large issue, but they could be again, especially if we hit a stretch after the election when there's a basic loss of confidence in the way our system is functioning. In the context of a disputed election, I could see a substantial judgment by investors not to want to hold U.S. assets, and certainly not to want to hold U.S. assets as a hedge against risk. So we've been in a period where the focus has been on the interest bond market, the focus has been on the stock market, the focus has been less on the foreign exchange market, and I'm wondering whether that's something that will deserve a careful look going forward. I think it could also go in the other direction. The dollar's traded down significantly in recent months, and maybe the euro deserves to have strengthened, or maybe this is something of a false dawn in Europe, and Europe's going to encounter a variety of challenges going forward. I just think there's more happening that could hit the value of the dollar than there has been in a while. And so people need to be braced for significant changes in exchange rates and for those to ramify into our markets. More broadly, I think that so far, emerging markets have provided less drama than most of us would have expected during the COVID period, and that could easily change in the months ahead. The figures today suggesting almost 1 million new cases of COVID in India were pretty scary.
Right. And maybe we got a little bit of a taste of the uncertainty about the currency markets this week when the pound really took it on the chin after Boris Johnson said he was just going to walk away from his deal. But how do you discount or how do you price in a really uncertain result of the election? Not who's going to win, but even whether we're going to know it and what it will take to do that. I'm a lawyer. I've studied law. I've covered these elections a long time. I really don't know how to project what's going to happen in November, December, even January, perhaps.
I think that's a real risk. I think it's a risk for the dollar. I think it's a big risk for equity markets. If you look at what traders would call the forward curve of volatility, it is showing record high levels of volatility standing out around the period after the election. There's likely to be some substantial difference between the people who vote in person and the people who vote by mail, which means that the votes that are counted on Election Day could give a quite misleading signal as to the result of the election. The Bush v. Gore thing was a serious challenge to the quality of American democracy, but there was no one who doubted that if some legal process ended in Al Gore losing the election, he would accept that defeat and urge his successors to do so. And the same thing was true with respect to President Bush. I'm not sure we can say that right now about the current president of the United States. And I think that does create a huge aura of uncertainty, and finally, which will have economic and market consequences.
Yeah, and finally, Larry, what about conventional wisdom? Where was it wrong this week? Often we find it's wrong. Where did you find it particularly mistaken?
I think where it may be wrong on a very broad issue, David, is conventional wisdom thinks that what we have to fear is a super strong Chinese economy. I think we have to fear at least equally much that China hits huge economic turbulence, and in order to keep their society together, they rally around nationalist ideas and aggressive ideas, and that becomes a source of conflict between the United States and China. I am as nervous or more nervous about Chinese economic failure than I am about Chinese success. And I think the conventional wisdom should be as well, and it isn't.
Yeah, you don't want to have a wounded China feeling they're in a corner. We don't know what they might do.
We don't at all know what they might do, David, and there's plenty of history of leaders turning to nationalism and to blaming foreign powers when they have domestic difficulties as a way of rallying their populations. And the legitimacy of the Chinese government has depended on the economic success it has delivered. And if that economic success starts to diminish, they will need other sources of legitimacy, and aggressiveness within Asia and hostility to the United States and pointing to purported American threats are potential sources of that legitimacy, and that could lead to a much more contentious world.
Which may read against the election, actually, because a disengagement of the two economies between the United States and China would not help China in that regard, if that's something that we are terribly concerned about, right, Larry?
Yes, absolutely. Yes, I think that's right, David. I think that if you see a period of huge uncertainty, who could imagine that there'd be doubt about who is in charge? in the United States, or what the lawful order was. That has to be something that potential adversaries look at and that potential asset holders worry about.
And that is what Summers says. Many thanks to our special contributor, Larry Summers of Harvard. We'll be right back. This is Wall Street Week.
It is not a coincidence that 2 of the 4 planes hijacked by murderers on Tuesday targeted the World Trade Center, the very symbol of the economic revolution that is dramatically raising living standards on every continent, and by spreading the marvelous blessings of free enterprise and individual choice, is empowering people everywhere.
That was Louis Ruckhiser, days after the horrific attack 19 years ago. This week, we mark the 19th anniversary of 9/11, that beautiful September morning torn apart by commercial airliners used as weapons to strike at the heart of Wall Street and of Washington. Almost 20 years later, it may be a virus now that has shaken us to our core, changed our lives, and made us feel less secure. But back then, it was a terrorist attack. We talked with one of those profoundly affected by 9/11, Dan Chung, who is now CEO of Alger Management, a firm that lost 35 employees that day, including the president of the firm, David Alger.
The 35 people represented basically our entire investment team. I was the most senior person to survive, but I was only 39 years old at the time.
And as a practical matter, when you wipe out that much of your organization, did you consider not going forward, just shutting it down?
I'm sure some of us thought we would go out, and that was, in fact, I think even in some of the, the rumors. But I personally, Fred Alger, we never considered not trying to rebuild. It was really important to us to try to honor the people that we had lost, and then also, to honor the firm's history in the investment world by trying to rebuild and hopefully succeeding.
Alger Management not only survived, but in many ways it's bigger and stronger than it was even back 19 years ago. How did you get from there to here, given the fact that you were almost on the grounds of extinction, and there you've come back even stronger? How did you do that?
Well, I think, I realized that the word honor is very important to me. And so honoring the people, honoring the process, it instinctively led me to first that if we were going to rebuild the firm, we had to rebuild it as in the same philosophy, in the same culture and process that my lost colleagues and David Alger had built. That's what they had worked so hard for. And so I realized that the people who could help me do that were what we call Alger alumni, people who had learned at Alger, often gotten their first break on Wall Street, and for some of them it would have been a tough to get kind of break, and then went on to success other ways. And so I was very fortunate to have a few alumni basically volunteer to come back to help rebuild the firm. And that's when I realized, talking to them, that as you look back on who was meaningful to you in your lives, it's often the people who gave you your first break, or who gave you the tough lessons that later on led to your success. And so I had a few of those willing to come back, and all committed to rebuilding Alger in our same philosophy and process, and in believing that that's the way we would honor both the lost people and their work, but also their personalities, by trying to keep our culture alive, because that's what they cherish, that's what they committed their effort to.
Your company, Alger, clearly had a fairly strong DNA before 9/11 happened. As you look forward to today, how has 9/11 and the loss of those 35 beloved colleagues, how has it changed the DNA of Alger Management as you see it today?
I think today the way it's changed a bit is that, and I'm proud of it, is we've made sure that meritocracy rises all the way up to the top. So I have now multiple partners who have come from different places. Many have been, of course, at Alger for a long, long time now. And we continue to train and promote people. And this time, I hope it's for the generation beyond me. I mean, to give the firm a life. As David used to hope that we would be the best manager over a 100-year period.
Dan, as we look forward now, we're 19 years past 9/11. We had a crisis then. We have a different sort of crisis, but one that's nonetheless very profound right now with this pandemic. We've lost a lot of people in New York and elsewhere in the country. We've shut down a lot of the operations. Are there any lessons you think that we could learn from the resilience of Alger management and perhaps of New York, the markets themselves, for today?
I think one lesson, first of all, is if you focus in on what's good in people, what's good in your colleagues, what's good in your community, and then you think about how you can contribute to that. And frankly, always believe that while change is jarring, change is upsetting, and this crisis is in many ways much worse than 9/11 because so many lives lost across our country. But I'll never forget after 9/11 the coming together in New York especially, but also across the US for New York. And I think there's a lot of opportunity here if people focus in on what's really important in their lives and what the good is in others and in what their work is, and try to realize that there is always a brighter future. You always should remain, I think, optimistic. I mean, I hate to say it, but part of the success of our resilience after 9/11 at Alger was not just the passion for rebuilding, the idea of honoring, but our just optimistic belief that we could do it, we could rebuild, and we could rebuild not just to be in business, but actually to be one of the best in the business again. We really were dying to prove that. I mean, we were really, really committed to proving it, and frankly, we have proved it. We are not just surviving; we are one of the best in the business in what we do. And I think America in this COVID crisis, we're seeing many changes that are jarring, like remote working, right? But we all know that remote working, I hope it does continue after this crisis, because I think it could offer a lot more flexibility for workers. You might actually get more loyalty and efficiency for businesses, because that's what we've seen at Alger. Actually, there's a lot more of efficiency, not getting in taxis and going around the meetings. And as a result, you might see a better workplace, because it'll be with more flexibility, more people can succeed. And so I'm quite optimistic that, future years, New York, our country will actually learn to adapt and benefit and improve from this crisis.
Tell us about the 35 candles.
Yeah, so that's a memorial to the 35 people we lost at Alger. It's a painting we commissioned from a local artist. And I got to give credit to the artist. He listened to me about what I thought was important. And I said it was important that they were all individuals. They were all unique. And yet they came together at work and accomplished great things. We ended the 90s as the number one strategy in the entire universe. And this artist realized that the idea was candles. There are 35 of them. They're unique, but they're in the same format, and they're hung together in our office as a single piece. And so that's sort of our way of symbolizing, both the individuality of everyone, but also that we do come together, in this case for our work.
That was Dan Chung, president of Alger Management. And we leave you this week with some of the commemoration of the 9/11 anniversary.